Good evening, everyone. I hope everyone is doing well and fine at their respective places. Very good evening, everyone. I welcome you all to my session on financial management. Uh, we'll be doing the topic of sources of finance today. Sources of finance. That's, I suppose, the types of finance as a topic. I think that's the second topic in your ICAI module. Uh, I think we are done with the first chapter, wherein it was scope and objectives of financial management. It is about the introduction chapter, right? Uh, so here today we're going to discuss about the various sources of finance. Uh, I assure you that this evening is going to be really fruitful for all of you. With our packed, we'll be having a lot of discussion. We'll be having a lot of interaction and also getting to know some very unique sources of funds apart from what we really know in the recent scenario. So without any more waiting, let's just get started. I have something really interesting for you all, which I'll be sharing you towards the end of our session. Just to give you a glimpse of that. Anyways, we'll be discussing about, we'll be going through maneuvering over that same thing. Just to put it up, I have this particular power pack uh, slide, you say, or you say it as a chart, diagram, whatever. This is what the entire chapter is. The entire sources of finance. I just tried to put it up in this particular chart that you observe behind me. So we're going to discuss the entire chapter through this chart itself. So before we go to that chart, let's first have some sort of interaction, some basic understanding of uh, what are the sources of finance that we are really aware of. Okay, so let me just target this particular subject. And also maybe I'll try to give my way of understanding or introducing this typical subject. When I say financial management, uh, the basic word we say management is all about. Uh, I understand it in a sense that so management means simply doing two tasks. One is raising the resources, and other is utilizing those resources. One activity that a manager performs is raising of resources and utilizing of the resources. So if you talk of an HR manager, uh, the person is responsible for getting the uh, good quality person or qualified, skilled persons into the organizations and then allocating them the appropriate job that they are entitled to. Directly coming to financial management, as a finance manager, what are we really supposed to do? As a finance manager, we are supposed to be just raising the funds and utilizing those funds. That's it. So these are the only two activities that a finance manager is supposed to do. He's supposed to raise the funds and he's supposed to utilize the funds. Now, raising funds from various sources and utilizing into various projects into working capital for short term, medium term, or for long term. Today's session, we are going to target about what are the various avenues of raising the funds. We are specifically targeting today where to raise the funds. So I just want everyone to be a bit of interactive. It's okay, there will be some lag, but I just want the interactions from your end. Questions should come up from your end. At any point of time you want to ask anything, you can just put your query. I'll definitely be answering them in the same class itself. And if it's a matter that we are supposed to discuss it like after the next concept is done, then definitely I'll let you know about the same thing. Okay. So be free to ask your queries, and also please be responsive to my queries also. Okay. Uh, so talking of raising of funds. Uh, Tell me, what are the various avenues that company has? Because let's talk about a bigger picture. We are not talking of a sole proprietorship. We are not talking of a partnership fund. We're not talking of a even like a trust or a cooperative. We are talking of a joint stock company. Maybe a listed. Uh, let's think from the point of view of listed company only. So if you talk of joint stock company, uh, what are the various sources of funds that you guys are aware of? What are the various sources of funds that you guys are aware of? Uh, I'm pretty sure first answer would be sure shares. If I ask you what's the further classification of shares, you will give answers like a company can raise funds either by equity shares or by preference shares, right? Uh, Secondly, you will say bank loan. Secondly, you will say, sir, bank loan lenge. Maybe third, you will say maybe a listed company. Since it's a listed company, the company can raise funds by way of debentures also. Okay. Any other answer apart from these things? Bank loan, debentures, shares, equity or preference share. Any other answers apart from this? Because these are like a common running items which any person, even a 12th standard student, even a 11th or a 12th standard student will be able to answer. How to raise the funds? These are the various sources by way of equity, by way of preference share, by way of bank loan or by debentures. Any other sources of funds that you guys are aware of apart from these things? Don't look into the module because if you're looking into the module, I'll definitely be able to catch you. Retained earnings, okay, that's a new thing. Retained earnings, okay. Shares, debentures, bond, borrowings from bank. If someone is looking into the module and answering, I can definitely make out from the answers because it's in the same order in which we have in the module. Okay, fine. So our target today is to learn something more than these sources of finance. Our target today is to learn something more than this. We just don't want to be constrained. We are not a commerce or typical commerce BCom students who just want to be looking into the commerce world from a superficial way. We need to have an in-depth understanding of the finance world, and that's what our profession requires, right? So that's what our profession require, that to have in-depth understanding. Even our CS syllabus is on the same lines, that we need to have an in-depth understanding of whatever concept we are learning, be it any subject. So same goes with finance also. Uh, so with finance, we are definitely going to look into very innovative ways of raising funds through various sources. Maybe I'm not going to name them. Let's keep it a suspense. As and when we come across it, we'll get to understand a lot of innovative things into it. Apart from what we have in the module, there are a lot of other sources of funds, ways of raising funds that we can look into. If you guys want to really make a career in finance, it's a request from my end. Starting from day one, you should start reading the pink papers. When I say pink papers, you should read into the Economic Times or maybe Mint or whatever. You'll get to know really what is happening in the outside world, and that will really help you progress in your career. So I'm really getting good answers like government grants, okay, security deposits, deposits, public deposits, ADR, GDR, okay, non-funded financing such as bank guarantee, okay. Really high funder words I can hear. Great. Let's simply get started with the sources of finance. I'm going to uh, go through this chapter not by way of a formal PPT or something like that, because I have my own way of teaching and explaining the concept. So And for that itself, I have prepared this entire chart for sources of finance. This entire chart I have prepared for the purpose of sources of finance. So this is going to discuss all about in between this chart and some of the workings that we are going to have. See, whenever we are going to raise funds, whenever we are going to raise funds, ideally, I can classify the types of funds or classify the funds that we can raise into broadly two categories. Means if you take a case of any source of fund, it will either be falling into the first category or into the second category. Now, right now, I'm not focusing more on the accounting standards point of view. So anyone who is well aware of accounting standards, what happens in India and all, please exercise some constraint because that is not what we are going to discuss right now. Okay. Don't worry, Anushka. We'll be definitely zooming into each of them, and I'll be also sharing this PDF. So don't worry about this, the fonts not being visible. It will be definitely visible. Don't worry about that. So as and when I will be zooming in, I'll be discussing each one of them in detail. So broadly, I say there are two categories in which I can bifurcate my funds into or sources of funds into. Uh, can any one of you just give a broad bifurcation of the sources of funds? What can be the two types of sources of funds? What can be the two types of sources of funds? Because any fund, any source of fund that I raise, it can be either coming from one source or it can be coming from the other source. So what are the two types of sources of funds? What are the two types of sources of funds? Voice is cracking. Is the voice cracking or is it all fine, everyone? Is it fine, everyone? Or it is fine? Good. No? Okay, which is good. Fine. So two types of sources of funds that I am talking of. That's basically owned funds and the other is borrowed funds. So it can be owned funds or it can be borrowed funds. Long term, short term, we can further bifurcate it. But owned funds and borrowed funds, these are the two broad categories. Instead of saying debt and equity, sometimes equity creates a mindset that it's equity share funds. No, we're not talking about that. We're talking about broadly as owned funds and borrowed funds. And that's where my first classification that you observe in the chart, sources of funds, that goes into two categories, into the borrowed funds category and into the owned funds category. We can have like owned funds or borrowed funds. That is what I initially said, that there are two sources of funds. One is owned and other is borrowed funds. So we have owned funds and borrowed funds. Okay. Let's discuss about first the owned funds. Let's discuss about the owned funds. Okay. Owned funds. In the owned funds, I have classified that into two categories. One, it is a domestic fund, and second is raising through international sources. So we can raise international sources also own funds. Yes, we can. We can definitely raise the funds through from the international sources also, which can be owned funds also. Okay, so I won't be talking much about these factors because these sources of funds, because we are like already aware, we are knowing all of them. Something different we'll be discussing more in detail. In domestic, I further classify that into two categories. One is raising it through external sources. Secondly, raising it through internal sources. Are you going to upload this chart? Yes, Anushka, don't worry. I'm going to upload this chart uh, today itself before the lectures, before the session ends. So you'll be getting it on the portal. Don't worry. So you need not take down any notes. You can just participate in the discussion. Okay, so we can classify our own funds into domestic, which will be like external or internal. Be like external or internal. So external sources or internal sources. External sources means you have to go to the market and ask for the funds from the public at large. Or internally, the company might have generated certain profits which it wouldn't have paid out as dividends. So any profits that are generated which are not paid out to the owners, to the shareholders, those are going to be categorized into retained earnings. Those are going to be categorized into retained earnings. So retained earnings are simply what we say accumulated profits flowed by the company back into the business. It means we haven't distributed our profits to the shareholders, but rather what we have done is we have retained it in our business and are utilizing it for our day-to-day activities or maybe invested in some assets. Obviously, these retained earnings are the rights or are the rightful uh, belonging to the ordinary shareholders, and definitely it increases the net worth. So you can say any company which is having a great degree or a good amount of retained earnings, any company which is having a good amount of retained earnings, that is definitely be valued on a higher scale. That is definitely going to be valued on a higher scale because it has got all the retained earnings invested in its business. The value of the business is also going to be higher in case of company which are having high retained earnings. Okay. Then coming to uh, the external sources of domestic owned funds. Uh, what are you saying, Christina? Sir, external domestic owned fund is borrowed. External domestic fund is borrowed. No, no, it isn't borrowed. External is all about, we'll discuss about that in a later stage. External domestic owned fund. That is, in external sources of domestic owned funds, we have two sources. One is a equity share capital, another is a preference share capital. Equity share capital and preference share capital. So when you say equity share capital, we already know all these features of the equity share capital. So it's a permanent capital. Never ever say in your life that equity shares are going to be redeemed, because if I'm on the interview panel, I will be like, you're not a commerce guy, because equity shares are never going to be redeemed because that's a permanent source of capital unless and until company is going for something like buyback or company is going for something like liquidation. Then only the equity shareholders are going to get some money. Otherwise, equity shareholders are not going to get money. So that's a permanent capital. Secondly, it's a representative of the ownership. Anyone who has got an equity share capital is a part owner of the company. That indicates residual interest in income and assets. It has got the highest cost of capital. Equity share capital has got the highest cost of capital. Now, this is really uh, important thing because sometimes we feel that equity shareholders have paid the money and we need not pay them dividends. There is no hard and fast rule that the company should pay dividend to the equity shareholders. There is no binding effect on the company. So we say that company need not pay anything. So equity shareholders are like they are no cost, zero cost fund. No, it's not like that. When you say high cost of funds, the equity shareholders are definitely having a higher expectation from the company because they have become the owners of the company. So they are not interested in just a fixed rate which you will be getting from the bank. Okay, so what you want, what you should be looking for is that what is the expectation of our equity shareholders? Expectation of equity shareholders is definitely higher than what your normal banker asks. In fact, a normal banker says, give us 10%, 12%, that is okay. But In case of equity shareholders, the shareholders are they're going to be silent spectator of your business performance. If your business is not performing as per their expectation, they will sell off the shares. They'll sell off the shares, and they are simply going to downgrade your company value. And reduction in the company value is a huge cost, right? So that has got a highest cost of capital. You'll get to know more about this uh, in the subsequent chapters of FM. Then it provides a security to other fund providers. Why do we say that equity share capital is going to provide security to other fund providers? Because when a company is having a good degree of equity funds, whenever we say that a company is having a higher extent of owned funds, the quantum of borrowed funds is minimal. It means the company is in a less risky situation, right? So if a company, if we say, let's say a company has equity shares worth 100 and debt which is worth, let's say, 50. There is another company where equity is like 125 and debt is like 25. So we generally say that this company is like a better or it's in a safe situation because owned funds are a higher proportion and debt is a lower proportion. So therefore, we say that equity funds are going to provide a greater degree of security to the fund providers. Now, what are the advantages, disadvantages? As I said, it's a permanent and irredeemable. So there is no pressure on the company that next year or going 2 years ahead, I have to refund the money back. So that's not the case. Secondly, it increases the financial base and help facilitate additional borrowing. So we say it increases the financial base and helps facilitate additional borrowing. So when you have a greater degree of equity, when you have a greater degree of equity, that acts like a greater security to the fund providers, that is bankers. Right? So if you have a good amount of equity fund capital and lesser amount of borrowed capital, the banker which you are approaching will be in a safe situation. Will say, okay, so this company seems to be safe because it has got a good amount of owned funds. Then, what is the residual interest in income and assets? The residual interest in income and assets means the equity shareholders are going to get the profits only once the preference shareholders are paid off, only once the interest on borrowed funds have been paid off, then only the equity shareholders will be getting returns. If all the income that company has generated, if that is used for paying off the debenture holders, bank loan, or the preference shareholders, equity shareholders is not going to have anything in its hand, right? Does just having high expectation on returns mean high cost of equity? How do we measure the cost of equity in such case? The cost of equity will be measured uh, by using some models. In fact, how to measure cost of equity? It's a matter of research since last 50 years. So since last 50 years, many research have been undertaken, and we have good amount of models with that. We'll get to know about that as and when we go to the chapter called as cost of capital. In that chapter, we'll get to know how do we compute the cost of equity based on the expectation of the equity shareholders. Okay. For the next one, the advantages: permanent and irredeemable capital. It increases the financial base, so that help facilitate additional borrowings. So if a company is having a greater amount of equity, it can easily approach a banker for further loan. There's no obligation to pay dividend. That's quite issue. That's quite easy. And you can also have rights issue. So company can also make a rights issue to raise additional capital. We talk of disadvantages. Dividend income is taxable in the hands of the shareholders. So I'm talking, this is not a disadvantage from the point of view of company, but rather it's disadvantage from the point of view of the equity shareholder. It's a disadvantage from the point of view of the equity shareholder because equity shareholder is going to receive the dividend, but that dividend is going to be taxable in his hands. Okay, so it's no more that earlier it was a case that if you receive dividend, you don't have to pay any tax. But right now, dividend income is taxable in the hands of the shareholder. It's no more remaining a tax-free income. Secondly, it's a risky investment. So from the point of investor, buying shares of a company is a bit risky. You cannot be sure that what is the value of your investment going to be maybe 5 years down the line. Reduction in EPS. So EPS is earnings per share. EPS is earnings per share. That is for every share, how much income is being generated by the company. So if you issue more equity shares in the market, you're going to issue more equity shares in the market, then obviously you're going to have a large number of quantum of equity shares. So that will lead to like reduction. That will lead to reduction in the earnings per share, because as you issue more equity shares, the number of equity shares increase, earnings of the company may be remaining same. So that will reduce the EPS. Last, we say dilution of ownership and control. So if you are going to issue more equity shares, the existing equity shareholders are going to lose control, right? So they are going to lose control. If you are adding more and more members, the older members are going to be having a less power in the company. That's about the equity share capital. More or less, we know all of these points. Let's simply go to the preference share capital. So when we say preference share capital, we say it's a hybrid form of financing. When I say hybrid form, preference shares has got a characteristic of both equity as well as debt. So how it is equity? Because it gives you a residual interest. Because it gives you a residual interest in the company. So how is it debt? Because you have to pay a fixed rate of dividend. You have to pay a fixed rate of dividend to your preference shareholders, and therefore it's what we say as a hybrid form of finance. Secondly, the rate of dividend is higher than the rate of interest. So they say the preference shares, since they are undertaking some amount of risk, therefore they need to be compensated for that with a higher rate of dividend. Third, the various types of preference shares that we say, various types of preference shares are like, they can be cumulative, they can be non-cumulative, redeemable, participating, non-participating, convertible. So cumulative, non-cumulative. Let's understand these two first. Sushil, what are you saying? Dilution means reduction in the control. Okay. So when you say dilution, it means reduction in the control. So for example, if you have, let's say, suppose earlier there were 100 shareholders, or I can say, suppose there were earlier 100 shares. So our investor who was holding 10 shares, he was actually getting 10% voting right. He was getting 10% voting right because out of 100 shares, he was able to exercise 10 shares, exercise voting on 10 shares, and that was like, it was giving you 10% voting rights. Whereas when the number of shares increase, like if you issue new equity shares in the market and your number of shares become, let's say, 200, so this same 10 shares, the investor is still holding the same 10 shares. But now the percentage voting that he is going to have, percentage voting power or voting right he is going to have is like 10 shares on 200. So that is like 5% voting right. So that is like, we are saying the reduction in the voting power. There comes a reduction in the voting power if you issue new equity shares. Okay. Coming back, so preference shares can be cumulative, non-cumulative, or redeemable, or participating, non-participating, and convertible. So what do we mean by cumulative preference share? Disadvantage of reduction in EPS only because of the assumption that the profit is constant. Yes, Abhishek, you can say that from that point that profit is going to be constant. So if you issue new equity shares, EPS is going to fall. Okay. So cumulative and non-cumulative, we already know about these two types of shares. Cumulative shares is like when you're in case of preference shares, suppose if you don't have profits, if you don't have sufficient profits, so what you do is those you don't pay the preference dividend, and that gets carried forward to the next year. That gets carried forward to the next year. So next year when you have profit, you have to pay profits of the past year also, because it's a cumulative. Non-cumulative, it means you're not supposed to pay dividend if you don't have profits. So next year, if we have profit, still you don't have to pay for the previous year. So you are supposed to pay profit only if you are earning. You're supposed to pay dividends only if you are earning profits. Redeemable, we know preference shares are definitely bound to be redeemed. You cannot have a irredeemable preference share. The preference shares can be participating or non-participating. It can be convertible also. Now, what do we mean by participating and non-participating? When we say participating preference share, it means after a point of time, preference shares will be entitled to participate in the excess profits of the company after a threshold is reached. After a threshold is reached. So that's a participating. It means they stand along with equity shareholders if the company is having profits in excess of a given threshold. Profit, if the company is having profits in excess of threshold, then the preference shares are also going to get uh, then the preference shares are also going to get uh, uh, share in the profits of the company. Non-participating, it means they are not entitled to any additional profits, just the dividend that was promised to them. Convertible. Convertible preference share means right now we have a preference share, but going ahead in future, instead of redeeming them by cash, what are we going to do is we are going to convert it into equity shares. So these are various types of preference shares. Cumulative, when the shares are when the dividends are cumulative, accumulating from year to year. Non-cumulative, when profit is there, then only the company going to give profit. After that, no more dividends will be distributed. Redeemable, if it is redeemable, then we say that it's going to be redeemed in cash on a given date. So convertible, it means when we say it's convertible, it means the shares will be automatically converted to that will be automatically converted to equity shares. Participating and non-participating, it means whether you can participate, whether you can take share of the excess profits. If the preference shareholders are entitled to take share of the excess profits, then participating. If they can't, then it's a non-participating. Okay, some of the advantages, we say no dilution in EPS. So if you are going to issue additional preference shares, the EPS that the equity shareholders are going to get, that's not going to get diluted because no more equity shares are added. Advantage of leverage. Now, advantage of leverage, when we say what is that? It's like using the borrowed funds for the purpose of getting excess return. So this particular term, advantage of leverage. So we're going to look at this term of leverage in the next chapter. There is a concept of trading on equity in ratio analysis. We'll get to know what is this leverage. So leverage means they're going to use borrowed funds for the purpose of generating higher returns. There's no risk of takeover. So if you're issuing preference shares, there's no risk that your company will be taken over by someone, because only a person with like equity shareholding can have a control over the company. Dividends are fixed and pre-decided, so there is no uncertainty with regards to how much dividend you are going to get. They are supposed to be redeemed after specified period, so it's not a permanent source. It's like you need to redeem it. Please explain what is meant by leverage. Anushka, I'll be speaking about the leverage in the next class, because that time when we have the ratio analysis, that time we'll understand this term leverage. As of now, just understand leverage is using borrowed funds to generate excess or generate good returns for your company. Using borrowed funds, when you take borrowed funds and use it in your business, you will be able to generate a higher return that we will be looking at in the next sessions. Okay. Disadvantage, again, preference dividends are like not tax deductible from the company point of view. The company point of view, preference dividend that you pay, those are not tax deductible. They are not allowed to be, tax deductible. For interest, you can claim them when you're paying interest, you can claim that as a tax deduction, but not the preference dividend. Cumulative preference shares is advantageous for cumulative preference share is advantageous for the investor, because even if the company is not having profit in the current year, next year when the company is going to have profit, the investor is going to get that. Risk of takeover. Okay, no risk of takeover. What do you mean by that? Okay. When you say no risk of takeover, when you have issued preference shares, if someone buys the preference shares of the company by investing a huge sum, still your company is safe because that won't be taken over by anyone. That won't be taken over by anyone. Your company is absolutely safe because even if you have preference shares, you don't have the control over the company. You can take over the company only if you have like 51% or more of equity shares of a company. Okay. Therefore, we say there's no risk of takeover. So that is about the domestic owned funds. But if we pay dividend to preference holders, will it not reduce overall earnings and thus resultant EPS? No, Sanjay. Sanjay, yeah. Sanjay, it is not going to be that case. If you pay dividend to the preference shareholders, so I'm saying instead of issuing equity shares, if you're issuing preference shares, then your EPS will not reduce. Like if you wanted to issue equity shares, but instead of that, you issued preference shares. So earnings you are going to generate as earlier, but for equity shareholders, the number of shares is no more increasing. No dilution EPS. That's what I said right now. Leverage is balance between debt and equity. No, dear, it's not the balance between debt and equity. It's utilizing the debt funds for generating. It's utilizing debt funds for generating higher returns. We'll get to know what is that leverage in the next session. Definitely, just have some patience. Participating preference shares can participate in profit left after distributing equity shareholders. Not after distributing equity shareholders. I cannot say that because when you distribute money to your equity shareholders, it's a residual interest. So it's like there's a threshold. So if we cross a threshold, that if we generate superior profits, then in excess of that profits can be distributed to the preference shareholders. Like for example, if you say, if the company makes a profit of 100 crores and more, then the preference share will also be entitled to the profits. Okay. So if you're going to pay dividends to preference shareholders, will it not reduce overall earnings? As I explained to you right now, that when you're going to issue preference shares, instead of equity shares, the original EPS what you had will still remain constant. Okay, so that's the domestic owned funds. Then we have the international source of getting owned funds. But I'll not get on to that right now because I want to explain that with the help of an example. So international thing, let's look into that at a later stage. Let me just go to now the borrowed funds. Let me just go into the borrowed funds for further discussion. See, under borrowed funds, again, I have classified into international and domestic. And again, in that international domestic, we may have the borrowed funds as short term, long term, or medium term. And for that purpose, I have highlighted everywhere. If it is LT, that means long term. If it is ST, it means short term. MT means medium term. And if we have something like this, long term, short term, medium term, then it means it's a combination of, I mean, those funds can be raised for either of it. It can be for long term, short term, or for medium term also. Okay, so let's talk about uh, the domestic borrowed funds. Domestic borrowed funds. In case of domestic borrowed funds, let's talk about first only those funds which are long term in nature. In that, we have first seed capital. We have first seed capital. Now, what is seed capital? As we say, seed is a starting point of a fully grown tree. Seed is a starting point of a fully grown tree. So when we talk of seed capital, we are essentially talking of startup companies. So this seed capital is designed by IDBI, Industrial Development Bank of India, for startups. So obviously, in case of startups, they just have an idea. They need to work a lot. They need to obtain profits. They need to be able to sell their products. So generating profits and having surplus will take some time. And that is where the IDBI helps those startups by way of, we say that these are designed by IDBI for startups and interest free. They're basically interest free, but they are going to carry a service charge of 1% for the first 5 years. For the first 5 years, uh, IDBI is going to charge a service charge. So instead of you know giving instead of charging interest, they're going to charge a service charge of 1% for initial years. For the first 5 years, a 1% service charge रहेगा. So for 5 years, there's a breather for the startup. Startup is in a somewhat light situation that there is no pressure to pay the interest. So that's where we say service charge of 1% is nominal. We can definitely pay that. After that 5 years have passed, now the startup is supposed to establish itself, and that's where it starts at an increasing rate. Repayment and rate of interest that is charged depends on the repaying capacity with the moratorium of up to 5 years. It means how much interest will be charged after 5 years. How much interest will be charged after 5 years? That depends on how much what degree of capacity, what capacity has the startup generated. If the startup is well established, then it can definitely be asked to pay a higher rate of interest, or maybe repayment of the loan can be asked to be earlier than the expectation. Okay, next long term source of domestic fund is what we say as zero coupon bond. Zero coupon bond. Have you ever heard this word coupon? Not a discount coupon or voucher coupon, but anytime have we heard of this word coupon? Because we need to know what is this coupon. This word is going to crop up again and again. Are we aware what do we mean by the term coupon? Angel investors are also seed capital. Yes, definitely. Angel investors are also sort of seed capital. We can also provide seed capital. Again, that will be a negotiation between the startup and the angel investor. Yes, open, because unless until we understand coupon, we are not going to understand what is a zero coupon bond. Yes, what do we mean by the term coupon? Anyone? Coupon on bond, basically. Coupon on bond. What do you mean by coupon on bond? Coupon on bond or on debentures, maybe. Coupon means discount, interest rate, zero coupon attracts zero interest. Coupon is equal to interest. Great. So whenever we say coupon, it's the interest. Basically, it refers to an interest rate. Coupon refers to an interest rate. Now, why do we call this as a coupon? In olden days, what used to happen is this used to be our debenture, and in that debenture, we used to have certain coupons attached to it. Like normally, we have party coupons or the lunch coupons whenever you go for a buffet dinner or something like that. So same way, this used to be the main debenture or the bond. And here used to have the coupons. Coupons were attached. So it used to be like first coupon, second coupon, third coupon, fourth coupon. So if this bond is for 4 years, the debenture holders were supposed to detach the coupon holders. I mean the debenture holders were supposed to detach this particular coupon. So they are supposed to detach this coupon, and they were supposed to present this coupon to the company for the payment of interest. So anyone who gives the coupon to the company will be paying interest on that bond to the debenture holder. Okay. So every time you're supposed to detach those coupons and present it to the company, and against those coupons, the company used to pay interest. But right now, there is no concept of such detachable coupons. In fact, what we have right now is automatically the interest gets credited to your account. Right. So when we say zero coupon bond, it means there is no coupon. No coupon means no interest. No coupon means no interest. No, it's not like that. Uh, no coupon means no coupon means it means the company is not going to pay any interest. The company is not going to pay any interest till the maturity. So no interest is payable no till maturity. So we say zero coupon bonds are no interest bond issued at a discount and redeemed at par. They are issued at a discount and redeemed at par. Now, for example, if we talk of a debenture, let's say a debenture is structured like this. It is having a face value of 1,000, coupon rate of 10%. So the interest amount is going to be 300 per annum. Its interest amount is 300 per annum, and maturity term is, let's say, 4 years. Okay, this is a normal coupon. Then when we say zero coupon bond, we say face value is 1,000. Let's say here in case of debenture, your issue price was same 1,000. So it was issued at 1,000, redeemable at 1,000. However, during the period of 4 years, the company is supposed to pay the interest. Zero coupon bond is an innovative product wherein the company says, I don't want the pressure of paying coupon every year. So let's simply do one thing. Face value 1,000. Let us promise that we are going to redeem this at 1,000. But we say coupon is zero. It means no interest. So you mean to say, sir, interest amount is zero? Yes, rupees zero per annum. N is, let's say, 4 years. N is, let's say, 4 years. That is number of years is like 4. However, the issue price, the company says, if I issue such a bond that face value is 1,000, no coupon, nothing, and for 4 years, no one is going to invest in my debentures, and no one is going to invest in my bonds. So what the company does is, let us keep the issue price. The company keeps the issue price, maybe like 700. The company keeps an issue price of 700. So it says, you pay us the 700 amount, and on maturity we will pay you 1,000. So basically, it is offering you a 300 discount. So it's a debenture on which it's a bond on which no interest is payable during the term. No interest is payable during the term, but once the term expires, or when there is a maturity, you have to pay the full value or the full face value you have to pay. So therefore, we say they are issued at discount but redeemed at par. They are issued at a discount, this discount to the face value, and are redeemed at par, redeemed at 1,000. Okay, so these are typically zero coupon bond that we are saying. So zero coupon bonds are no interest bonds. They are issued at a discount, issued at a price price lower than the face value. But when we are supposed to pay them back, we pay them the full face value, and the difference between them is what the interest the debenture holders are going to, or the bond holders are going to get. Now, again, a type of zero coupon bond, a fancy word, we have like deep discount bonds. Deep discount bonds are again a type of zero coupon bond. So deep discount bond, what do you mean by deep discount? Again, as I said, it's a zero coupon bond. But when we say deep discount bond, it means you're offering very heavy discount. You're giving a heavy discount on, you're giving a very heavy discount on the bonds. So let's say face value is 1,000. We say coupon is 0. Obviously, interest is also rupees 0. And which anything should be, and then issue price. Issue price is like we are going to issue the bond at 100, and we are going to redeem it at 1,000. So we are going to issue the bond at 100, and we are going to redeem it at 1,000. So the discount that we are offering is 900 rupee discount. So we are offering a 900 rupee discount on this bond. And that's what we call it as a deep discount bond. So you're giving a very huge amount of discount. Very huge amount of discount. So you're going to issue the bond at 100. It means the investors have to pay just 100 rupee. And after some years, the investors are going to get back. The investors are going to get back 1,000 rupee. So a huge discount is offered, and therefore it's called as a deep discount bond. And but obviously, deep discount bonds are having longer maturity. Maybe N can be like somewhere around maybe 25 years. So it's like you pay 100 rupee to the company today. The company will pay you back 1,000 after 25 years. So longer is the term. That's the reason the company is offering you a higher rate of discount. Okay, so deep discount bond and zero coupon bond are into the same category. So they are issued at a discount and redeemed at a premium. And deep discount bond is wherein you are offering a huge amount of discount, and that's also a type of say a zero coupon bond. Okay, then let's go for this one. The next long-term borrowed fund is what we call it as secured premium notes, FPN. We generally say it as a SPM. So secured premium notes are again, we say redeemable notes issued along with detachable warrants. And warrants need to be converted within time period notified by the company, usually 4 to 7 years. Now, what are these secured premium notes which are issued along with detachable warrants? Now, what are warrants? Let's understand warrants. Warrants. Ever heard of this term, warrants? Anyone? Share warrants, not the arrest warrant. Arrest warrant, search warrant, not something of that sort. I'm talking of warrants, share warrants. Have you heard of this term, share warrants, anytime earlier? Share warrants. Have you heard anywhere? Share warrants, preference share warrant, or equity share warrant? No? Share warrants, nothing? Okay, see. Warrants are basically, it's a document. Warrants are simply a document wherein it will be stated that on a particular date, holder is entitled to some number of shares at some price. Okay, so this is like Warrant is simply going to be a normal piece of paper, normal piece of right to purchase something sealed. Okay, company gives me like right to purchase stock at a specific price. Okay, are you sure? Correct. Dividend can be given in share warrant. No, that is a dividend warrant basically, Jamil. Okay, so share warrants, it means it gives you a right to purchase the share at a specific price. So if I'm having this warrant in with me, if I'm having the warrant with me on the specified date, I'll go to the company. I'll give this warrant to the company. I'll say, the company, please take these warrants. And as per your specification in the warrant, I am entitled to maybe 10 shares at a price of rupees 20 each. So here the price of the share at which warrant holder is going to get the shares, that is fixed. Okay, so that is what we mean by warrants, right? So it means document which states that holders holding a certain number of shares on a future date at a certain price. On a future date, the holder of the warrant is going to get a fixed number of shares at a fixed price. That's a warrant. Now, here it says it says that secured premiums are redeemable notes issued along with detachable warrants. So when we say secured premium notes, we are saying secured premium notes. So if it's a SPN, it's a normal debenture. It's a normal debenture, sort of, it's normal debenture. But along with that, there is a warrant attached with it. So anyone who invests in a secured premium note, he is entitled to remove this warrant, take it to the company, and ask the company for certain number of shares. Okay, so warrant is a proof of holding shares. No, Anushka, it's not a proof of holding shares. It's a proof that you have a right to buy the shares on a future date. So secured premium notes are again a sort of debenture, but along with that, you have a warrant attached with it. It means on a due date, you can just detach that warrant, take that warrant to the company, and ask the company to give you some specific number of shares against those warrants. The company is going to pay interest on these debentures. Along with that, a secured premium note has this additional advantage of being partly convertible to equity shares also. Okay, so that's the detachable warrant. And generally, the time period that the company gives for converting those warrants to shares is like usually 4 to 7 years. Okay, then the next long-term source of fund is unsecured loans. Unsecured loans specifically provided by promoters. That in finance term, in technical term, we'll call that as a quasi-equity. That is also called as quasi-equity. Unsecured loans are provided by promoters. Unsecured loans are provided by promoters. Promoters means the directors. I hope you might be aware of what the promoters are. Promoters are the persons who are promoting the company or bringing the company into existence. So they are going to give unsecured loan to the company, right? So those loans are also a long-term source of fund. So those are unsecured, and that is done to meet the promoter's contribution norm. Meet the promoter's contribution norm. The promoter's contribution norm is what? See, suppose a company has equity share capital and debt. Company has an equity share capital of 100, debt of 50. The company is in need of additional debt. The company goes to the banker. Company goes to the banker and it asks for additional funds. The company says, no, no, we cannot give you any more funds because we pay only 50% of the owned funds that you have. So it says that if you want additional funds, you bring in some more capital. They say that we don't want to issue more equity shares. The directors, the promoters say we don't want to issue any more number of equity shares. So the company says, okay, you don't issue the equity shares, but bring in unsecured loan, bring in unsecured loan from the promoters. So promoters bring in maybe additional 50. So this 50 is quasi equity. This equity is quasi equity. It's like the owners of the company are giving loan to the company. It's like your father is giving loan to you, right? Or mother is giving loan to you. So it's like a sort of quasi equity. It's like a owned funds only. But yes, legally we say it's a loan, but sir, substantially, by matter of substance, it's never going to be repayable, or even if it is repayable, it will be converted to equity. So that's where we say it's a quasi equity, and that quasi equity, when it is bought, your total equity along with quasi equity will become 150, and you will be entitled to additional 25 bank loan, and that will make your bank loan as 75. So sometimes the promoters to bring in bankers require promoters to bring in additional additional capital by way of unsecured loan, which we call it as quasi equity. Detachable warrant means what? Detachable warrant means it's like a coupon which is attached to the debenture. So you have to remove that warrant, and you have to give it to the company for converting into equity shares. So against those detachable warrant, you'll be getting equity shares. Okay. So under domestic, we had like seed, zero coupon, and secured premium note and unsecured loan by the promoters under long term. Now under same domestic, we have the source of funds, which can be long term, short term, medium term, commercial bank, and floating rate bonds. So let's discuss about these. Commercial banks. Commercial banks, like you go to a banker, you ask for money from them, you want a business loan, so they give you funds for acquiring like property, plant, and equipment for working capital purpose or for some short term requirement. So loans can be raised from long term, medium term, or short term. Long term funds, you will be obviously requiring to acquire assets which are long term in nature. For example, let's say you want to acquire it for PP. Short term loans can be for working capital purpose, like if you want to purchase some stock, or you want to have some sort of spares in your godown, or you want to give money as you want to sell goods on credit, so you'll have some debtors. So for short term purpose, you have commercial bank loan. This concept called as bridge finance. The concept called as bridge finance. What are you saying? If the promoter can give loan, then why they need to go to bank? Share warrant holders are entitled to get dividend. Share warrant holders are not entitled to get dividend. They will get dividend once it gets converted to equity share. If the promoter can give loan, then why they need to go to bank? Because whatever loan the promoters can bring, that is not sufficient. Okay, so like in case the promoters can bring in like 50, but they needed a total funds of 75. That's the reason they bring in promoters funds as well as debt funds. Bridge finance. Bridge finance is a loan for a short period till disbursement of sanction loan. Generally, what happens when you are undertaking any project? When you're undertaking any project, you apply for loan. So when you apply for the loan, it gets sanctioned. Even after sanction, you need to wait for certain time period, right? You need to pay wait for certain time period till the money gets credited to your bank account. So maybe 15 days or 20 days or a month it will require. So during that time frame, you will need some amount of money to continue your business or to just kickstart your business. So to kickstart your business or kickstart your project, you will need some funds for shorter period, and therefore it's called as a bridge finance. It's a bridging bank. It's the bridge between the loan sanction and loan received. That's the bridge finance. Bridge finance is a loan for short period till disbursement of the sanction loan. If after taking bank loan, subsequently company pay back to promoters their loan fund, bankers will not allow. Anish, Nish. One is bankers will not allow you to pay back the money to the promoters. Bankers are not going to allow you to pay back the money to the promoters because otherwise it will be cheating on the banker, right? Banker, if you pay back your promoter loan, then the banker will ask for refund of their loan also. Do warrants update according to the bonus and stock splits, and do they have rights in rights issue? Uh, they don't have rights in rights issue, but they definitely update according to the bonus and stock splits. Whenever there is a bonus or stock split, the warrant also gets updated. Okay, so I've done this rich finance last. Let's go for the floating rate bonds. Floating rate bonds. So floating rate bonds, we might be aware of that when we take a housing loan or whenever we take a loan, the bank offers us two options. Either you can go for a fixed rate loan or you can go for a floating rate loan, right? Either you will go for a fixed rate or you will go for a floating rate loan. Okay. Fixed rate is like if it is 10%, so it's like 10% for 10 years. That's it. So it's 10% for 10 years. That's it. No more change in the rate of interest. Whatever be the rate of interest in the market, RBI may increase the rate of interest, it may decrease the rate of interest. There is going to be no impact on my loan because I'm going to get the same 10%. Floating rate loan. So if it's a floating rate loan, banker will say rate of interest is something plus 4%. So what is this something? Is this something? Because as I guess, how it can be that it is something and just plus 4%. So if that something is zero, then only 4%. Yes, but I need to define what is this something. Banker may say rate of interest is going to be the repo rate of RBI plus 4%. So as soon as RBI updates the repo rate, your rate of interest will also differ. So for example, year one, if repo was 5%, rate of interest applicable to you, rate of interest that will be applicable to you will be like 5 plus 4, that is 9%. If year two, repo becomes, let's say 6%, then the rate of interest applicable to you will be 6 plus 4, which is 10%. It means the rate of interest applicable to you will keep on fluctuating according to the repo rate. Your floating rate loans are basically those loans which are going to fluctuate. These are the floating rate bonds are like these are the bonds which are going to fluctuate. That is the rate of coupon is going to fluctuate. Whatever the rate of loan is, rate of interest is, that is going to fluctuate depending on market conditions. Like I said, the bank company will say, I'll pay you coupon at some rate plus 2%. What is that some rate? That some rate is like it can be RBI repo rate, or it can be RBI reverse repo rate, or it can be based on some bank FD rate. So that is going to be the criteria, or that's going to be the point about the floating rate. The floating rate loan floating rate bonds are the bonds which rate of in coupon is something is Libor or Mumbai bank rate. Yes, uh, correct, Jamil. We have something called as Libor and Mumbai bank rate. It's also called as MIBOR. In Libor or MIBOR, Libor is London Interbank Offered Rate. MIBOR is Mumbai Interbank Offered Rate. But slowly and steadily, I don't know whether you're reading the pink papers or not. We are doing away with Libor because recently a scam has been unearthed wherein bankers were fixing the Libor rate. Right? So Libor and Mibor can be one such benchmark. So floating rate is the rate of coupon is fluctuating depending on the market conditions. This is used for hedging against interest rate volatility and successfully issued by financial institutions like IDBI. So that is being issued by IDBI and ICICI. Can the floating rate be changed to fixed rate? Floating rate can be changed to fixed rate, but practically, Anushka, I will say you will never prefer to go for it unless the rate of interest is favorable to you. Right? Please distinguish between repo rate and reverse repo. Uh, Sushil, please refer CA Foundation Economics. There you will know what is a repo and reverse repo. Repo is the rate at which Reserve Bank of India gives loan or it gives funds to the bankers, and reverse repo is the opposite of it. What is the difference between repo rate and benchmark rate? Repo rate is again a type of benchmark. There can be other benchmark rates also. Okay, so there are a lot of things to discuss, but I cannot go into detail with each of them. Okay, so floating rates are used for hedging against interest rate volatility. So if you have a floating rate, then it's like, if you look into this case over here, when you had a fixed rate, you were supposed to pay 10% only throughout the life. But if you have a floating rate, then you are going to have an interest rate that is going to fluctuate based on the repo rate. So in year three, if your repo rate becomes like 3%, then rate of interest applicable to you will be also like 3 plus 4, which is 7%. So when you are taking a floating rate loan, you're actually protecting yourself from paying high rate of interest under the fixed rate. Obviously, you retain that risk also that you're supposed to pay a higher rate also if the repo rate increases. That is about the floating rate bonds. Apart from that, we have debentures, normal debentures that we say. So debentures are generally obviously issued by the public limited companies. It's a loan from the public. Denominations can be from 100 to it can be up to thousands. Debenture trust deed lists the terms and conditions. So that whenever you issue debentures, you need to form a agreement between the debenture holders and the company. So that debenture trust deed is what called as. Maturity period may be from 3 years to 5 years. Debentures are generally low cost of funds. And also they provide tax benefit because debentures, the interest that you pay on debentures, those all are tax deductible expenditure. It means you can claim that interest as your expenditure, and that is where you're going to say that it's a low cost of funds. It can be non-convertible or fully convertible or even partly convertible. Non-convertible, it means debentures need not be converted. Debentures is not going to be converted. That needs to be redeemed in cash. It can be fully convertible. It means the entire debenture will get converted to equity share on maturity. Or it can be partly convertible. Partly convertible means out of 1,000 rupee debenture, 500 will be converted to equity. Rest 500 will be paid off in cash. So it can be any such variation. Debentures, we can have it as a bearer, or also it can be registered or mortgage or naked. Debentures can be bearer. Bearer means that can be transferred from one person to another, just like a normal bearer check. It can be registered. Registered means it will be a register will be maintained to know who are the real owners of the debentures. Mortgaged, obviously, debentures are mortgage against the assets, or it can be even unsecured also, or it can be naked. Naked means unsecured. So remember, naked debentures means they are unsecured, and so it can be bearer, registered, mortgage, or naked. Mortgage days, the debenture holders are having a security on some asset of the company, or those can be even naked. Naked means no security, no such asset is being secured by the debentures. Okay. Inflation bonds. Let's cover up these two parts, and then maybe we'll take a short break. Inflation bonds. So whenever we're saying inflation bonds, the rate of interest, basically the rate of interest is adjusted rate of interest adjusted for inflation. TDS claim by company or lender. TDS is separate thing. TDS, obviously it will be whoever gets the interest is entitled to claim the TDS. It is very hard to focus. Okay, sure. Inflation bonds. So inflation bonds are the bonds in which interest rate is adjusted for the inflation purpose. For example, if the normal interest rate is 11%, inflation is 5%. If you have an inflation bond, then you are going to get not only the normal interest rate of 11%, but also what you have as an inflation of 5%. So you'll be getting both the things. You'll be getting both the interest, one what is 11% rate of interest, and also the 5% inflation. So it gives you a protection against inflation. So if in the economy if you have a higher rate of interest, higher rate of inflation, the bond will also pay you higher rate of interest considering the inflation factor. Okay. Next, zero interest fully convertible debenture. Zero interest fully convertible debenture. Those are basically compulsorily and automatically converted after a specified period of time, and holders thereof are entitled to new equity shares of company at a predetermined price. So zero interest, or against the zero coupon bond that we had seen earlier, that's the same thing over here, zero interest. It means the company is not going to pay any interest. And they're fully convertible to debentures. It means they are automatically converted to equity shares on expiry of certain time period at a fixed price, right? So for example, let's just look into this. Let's say if we have such a zero interest fully convertible, face value of 1,000, issue price of rupees 800, and these are like convertible to equity shares at a price of rupees 50 each. Can you tell me how many shares will be issued? If such a zero interest fully convertible debenture says we are issuing it at 800, face value of 1,000, no interest is payable, but it is convertible to equity shares at rupees 50 each. Sanjay, you're saying, is there actually any inflation bonds available in India? Yes, there are RBI, there are bonds which are issued by RBI, which are inflation indexed. Inflation bond to some extent, floating loan, yes, you can say somewhat, but floating loan is linked to a benchmark, whereas this is not linked to any benchmark. Yeah, can anyone answer this? Pretty simple. Face value of 1,000, which is convertible to equity shares at rupees 50 each. So how many shares will be issued against this debenture? How many shares will be issued? 20 or 16? Is it 20 shares or is it 16 shares? It is always going to be 20 shares because it's going to be 1,000 divided by 50, which is 20 shares. That's going to be 20 shares which will be issued because price that is fixed 50, that is based on a face value. So each share, if you are pricing it at 50, there will be 20 shares that will be issued on the date of maturity. Okay, so that's our fully interest zero convertible, fully convertible debentures, zero interest fully convertible debentures. Let's take a short break of 5 minutes now. Let's take a short break of 5 minutes now, and then after that, we'll discuss about the other things that we are pending in this particular topic. Okay, welcome back everyone. After the break, can you explain bridge loan? Bridge loan is the loan which is available for a very short term. Like you have a loan sanction, but you haven't yet got it in your bank account. That has not come into your bank account. It has not yet been disbursed. So till the time it is disbursed to you, you get arranged for that short-term loan, and that's what we say it as a bridge loan. Once you get the main loan, that when you get it disbursed, you pay off the bridge loan. Okay, some of the uh, short-term sources of funds. Let's quickly go through them. Some of the short-term sources of funds. One is advance from customers. So whenever you receive money from customers as an advance against the goods which you haven't yet sold them, that also acts like a source of finance for you. Trade credit. Trade credit is when you're getting loan, when you're getting goods, from the market, from your creditor, and the creditor allows you to make the payment after maybe 10 days or 15 days or maybe a month. So for those 1 month, you are using the goods of the creditor without making payment. So that also acts like a short-term source of finance. Accrued expenses and deferred or unearned income. So if you have certain accrued expenses, that is, expenses have occurred, it has accrued, but you have not yet paid it off. So if you haven't paid it off, so the money is with you. That acts like a source of fund for you. Then deferred or unearned income. So when we say deferred or unearned income, it means uh, the income which I have received, but I haven't yet earned. So I have received the income in advance. So that also acts like a short-term source of fund. What is the benefit of taking zero interest fully convertible debentures? It's a risky, as you said. This is, I think, Christina. Christina, the benefit of taking zero interest fully convertible debentures is you have that benefit of getting shares of a company at a very nominal price. Like in our example, we had over here 20 shares. 20 shares at a price of 50 each. So maybe at the time of redemption, at the time of conversion, these shares maybe which you're getting for 50, that may be priced at 100 or 150 or even at a higher price. Right. So that's the advantage that you can think of. Then these three are some sort of short-term sources of funds. Let's get another fancy thing, fancy word, fancy source of fund called as commercial paper. I don't know how many of you have heard this term earlier, commercial paper. When we say commercial paper, it's basically an unsecured money market instrument which is issued in the form of promissory notes. It's an unsecured money market instrument which is issued in the form of a promissory note. If you look at our Indian currency, you will find that it's written over there, Indian currency, that I promise to pay the bearer. So it's again a sort of promissory note. So commercial paper is also a promissory note, which is issued by whom? Uh, it's going to be a denomination of, sorry, it's issued by highly rated corporates, going to be highly rated corporates. So companies who are having good credit rating, good credibility, good standing in the market, only they are allowed to issue commercial papers. So it is issued by highly rated corporates, primary dealers, and also financial institutions. Okay, so it's going to be issued by highly rated corporates, primary dealers, and all India financial institutions. Again, commercial papers are not as cheap as any other source. I mean, you cannot get it in a smaller denomination. You need to pay a good amount for it. Each commercial paper is going to be in a denomination of 5 lakh or multiples. So you can get one commercial paper by paying 5 lakh. You cannot invest a lakh or 1,000 or 50,000. You need to have a minimum value of 5 lakh or multiples, like 5 lakh, 10 lakh, 15 lakh, so on. And the rate of interest that you get are basically linked to the yield of 1 year government bond. So whatever is the rate of return on government bond, whatever is the rate of return on the government bond, somewhat linked to that, maybe something higher than 1 year government bond. They are mandatory, obviously, to get the credit rating. So it is very much compulsory for the commercial papers to get themselves credit rated. Commercial papers are negotiable instrument. Yes, you can say they are negotiable, but sometimes even the company may ask for maintaining the register also. As we say, government bond, when government issues securities to the public, when government wants to borrow, they issue security, something called as T-bill. T-bill or the treasury bill. So T-bills are basically short-term government securities. The maturity may range from 14 to 364 days. So whenever the government wants to borrow for 14 days, or maybe more than that, but less than or equal to 364 days, that time government issues T-bills. And these T-bills are also issued in essence of a zero coupon bond. Just as the zero coupon bonds are issued, the T-bills are issued on the similar lines. They are issued at a discount and redeemed at a premium. Redeemed at par. Issued at a discount and redeemed at par. Commercial papers issued by highly rated corporates, T-bills issued by government, certificate of deposit are issued by banks. Certificate of deposit, they are issued by banks. So certificate deposits are basically document of title, similar to a time deposit. I mean, certificate deposit is similar to that of a FD, right? Saying, I guess because of my headache, I'm not able to focus as others have no problem with this background. Yeah, I mean, there's a discussion, guys. Is the black background okay, or shall I change it to white or something? The black background okay, everyone? I got a message that T-bills are issued by RBI for government. Yes, definitely. RBI issues the T-bills for the government. And I receive the answers. Yeah. So certificate of deposits, these are issued by bank. Remember, CPs, commercial papers are issued by corporates, T-bills by government, certificate of deposit by banker, except that there is no prescribed interest rate on such funds, and it is traded in the secondary market. So certificate of deposits are like the bank issues certificate of deposit. It takes money from you and it pays you the regular interest as it should be. On maturity, it will pay you the full value, and it is traded in the secondary market. That is traded in the secondary market. Secondary market means it's not that you have to return the certificate of deposit to the banker and banker will pay you back. You will have to trade it in the secondary market, just like shares are traded. Same way, the certificate of deposits are traded in the secondary market. Black is okay. Black is okay. Okay. Yeah, great. Certificate of deposit. When corporates issue uh, bonds to the in the market, they are also called as public deposits, and they are also subject to Reserve Bank. Just like banks can issue certificate of deposit, corporates can issue uh, public deposits, and they are generally going to be accepted for a period of like 6 months to 3 years. So it can range from a period of 6 months to 3 years. So you can take money from the public by way of public deposits. Uh, it can be from 6 months to 3 years, and there's an RBI regulation on it. There's a RBI regulation on it. So with regards to RBI regulation, they say maximum amount of yeah. So as per RBI, as we say that RBI says that you can issue public deposits from time to time up to a maximum of 35% of a paid up capital and reserves. This is what you will be learning also in your law. Intercorporate deposits is again another fancy term, which is short-term borrowings between the corporates. So if one company is having surplus fund, other company is in need of additional funds. So the company with surplus funds will definitely lend to the company with a shortfall. T-bills, yeah, T-bills are treasury bills. T-bills are treasury bills. Okay. Three types of bank accounts that we have: short-term loan, short-term sort of bank facilities, overdraft, clean overdraft, and cash credit. Overdraft, we know customers are allowed to withdraw in excess of the credit balance. It means they allow you to make your bank balance negative up to a fixed limit. Like they will sanction a fixed limit. Maybe they'll say like up to 1 lakh you can withdraw from your bank. You can withdraw from your current account. That's an overdraft. And these are repayable on demand, but generally continue for long period by annual renewal limit. Interest is charged on daily balances. So it's not that overdraft, whatever the limit you have, the interest will be charged on it. No. How much you withdraw, only on that amount you will be charged the interest. It's not that if you have an overdraft limit of 1 lakh, entire 1 lakh is going to be subjected to interest. No. It's going to be how much you withdraw. Like out of 1 lakh sanction, if you withdraw 20,000, only interest on 20,000 will be charged. So it's generally like for a repayable on demand, like the banker will say that this overdraft limit is valid for a year. But as soon as the year expires, you will be required to pay back the money. But banker will generally renew it. It means they will say, no, you need not pay now. Let me just renew the limit for you. So it will be extended. The loan will be extended for another year. Then clean overdraft. Now, clean overdraft and overdraft, the only point of difference between them, the only point of difference between an overdraft and clean overdraft is overdraft is issued against some sort of security. Maybe your stock, maybe your debtors, or maybe some gold, or anything you can offer. You can offer anything tangible, which can be used for availing the overdraft facility. Whereas clean overdraft, they are unsecured overdraft, which are granted only to financially sound firms having reputation and integrity. Right. So clean overdraft is sanctioned only to those entities who are financially sound and are of good reputation. Like so, any company which is not having a good track record of repayments, then they will be like required to they won't be granted this clean overdraft. The banker will ask, if you want to overdraft, give us some security. Okay, so they are generally granted for a short period and must not be continued for long. So RBI also says that you should not continue these loans for a longer period, because you will be then that's a risk for the bank. As a safeguard, bank takes guarantee from the other persons who are creditworthy before granting this facility. So apart from lending to just financially sound, the bank also takes personal guarantees of some third parties. Cash credit. So cash credit is another account. Cash credit is again similar to overdraft. It's an arrangement under which the customer is allowed an advance up to certain limit. The customer did not borrow the entire amount, and he can only draw to the extent of requirement. Interest is charged again only on the amount withdrawn. Generally, cash credit is sanctioned against pledge or hypothecation of tradable goods. Now, this is the starking difference that I talked about. The difference between overdraft and cash credit is cash credit is generally sanctioned against only tradable goods. That is only tradable goods. So they are going to be issued, or they are going to be sanctioned only against pledge or hypothecation of traded goods. Like overdraft, limits are also like renewed every year. So that's the starking difference between overdraft and cash credit. Overdraft can be sanctioned against any security, but cash credit is sanctioned generally against the tradable goods only. So questions: if public deposits are accepted for a maximum 3 years, then how it will be treated as short-term funds? Since it's ranging from 6 months to 3 years, so it can be short term or it can be, you can also say, medium term. Then clean overdraft are subject to sound credit worthiness of the corporate. Yes, definitely true. Then the last one is bills purchased or discounted by way of is another way of raising short-term funds. Even through bills are purchased by a bank, it can hold the owner of the bill liable in case of dishonor. So this is like discounting of bills, which we may have for discount, in your 12th standard, maybe you would have learned discounting of bills. So when you are going to give bill to the banker is going to provide funds by deducting the charges. So that is again a short-term source of fund. These are the short-term sources of funds. Let's look at these are the short-term sources, short-term domestic sources. Let's enter the international area now. So internationally, if I want to raise debt funds or borrowed funds, I want to raise internationally borrowed funds. What are the various sources? One is the development banks. Development banks like we have Exim, Bank of USA. All of them are like they offer a number of concessions to the foreign companies to invest within their country and to finance exports from their countries. So in India, we have the Exim Bank, which facilitates the funds for export-import business. In OD, is the interest charge and whole amount allowed or the amount withdrawn? Only the amount withdrawn. Only the amount that is withdrawn, interest is charged on that. Floating rate note, FRN, just like we have floating rate debentures in the domestic area, we also have floating rate note in the international area, wherein up to 7 years maturity is provided, and those are adjustable interest rates to reflect the exchange rates. So as the exchange rates fluctuate, the interest rates also are going to fluctuate. And obviously, they are considered to be cheaper than the foreign loans because taking foreign loan and undertaking the foreign exchange risk, that is another risk that you take. So these are adjustable interest rate, which is going to be reflected in the exchange rates, and they are cheaper than foreign loans. Cash credit are secured by floating charge on current asset of company. Yes. What is the major difference between OD and cash credit? As I told you, OD will be sanctioned against any asset. Cash credit will be sanctioned only against current assets, basically current, and moreover like the tradable stock. Euro convertible bonds. Now, Euro convertible bonds, they are basically going to provide an option to the holder. So if you are a holder of a Euro bond, what is this Euro bond? Just give me 2 minutes, I'll let you know. They may be converted to equity shares. So it provides an option to the holder that if you want, you can convert that bond to the equity shares. They may be callable or puttable. Then Euro convertible zero bonds. So Euro convertible zero bonds. So let us first understand what are these Euro bonds, and then we will talk about convertible or zero bonds or whatever. What are Euro bonds? Generally, Euro bonds, we say, these are the debt instruments which are not denominated in the currency of the country in which they are issued. So it means Euro bonds are definitely debt instrument, just like debentures. They're just like debentures, but they are denominated in a currency of the country in which they are issued. It's basically like a rupee note issued in USA. So generally they are issued in a better form than as a registered bond. So Euro bonds are the instruments, debt instruments, debentures, bonds, which are denominated in currency of the country other than the country in which they are issued. So for example, we have US and let's say India. So an Indian company goes to US and issues bonds which are denominated in INR. Same way, if a US company comes to India and issues bond which are denominated in dollars, that is also a euro bond. So don't go by the name that euro means something Europe. No, euro has nothing to do with Europe. Euro bond simply means these are the debt instruments which are denominated in the currency of the country, which are not denominated in the currency of the country in which they are issued. So they are some other currency, right? So an Indian company going and issuing rupee bonds in US, or Japanese company going to Britain and you issuing yen bonds. So those are euro bonds. So such euro bonds are of various types. One is euro bonds with equity warrants. Euro bonds with equity warrants, which is a regular bond with detachable warrants. So normal bond that we had, secured premium notes we had in the domestic source. That same thing what we have is in the international source. Convertible bonds, these are the convertible euro bonds, they can be converted into equity shares on a future date. Euro convertible zero bonds. Euro convertible zero bonds means we need not pay any interest on that, issued at discount and redeemed at par. As we have seen, the zero coupon bond. They're having a usually maturity of 5 years and conversion to equity on maturity at a predetermined price. So it's like normal domestic thing. We just have a fancy name that Euro convertible zero bonds. We need to understand what is this callable and puttable bond. Maybe callable or puttable. Let's understand what is this callable and puttable. Callable bond and puttable bond. What's the difference between both? Denominated means issued at foreign currency. Yes, you can say that. Callable bond. What are callable bonds? Listen. Callable bonds simply means company has the right to redeem bond before maturity. Company is having the right to redeem bond before maturity if price is above certain limit. Puttable bond. Puttable bonds are the case where bond holder has the right to return bond to company if price falls below certain limit. So when you say callable bond, you can think of it as think of the callable bond as like the company will say that it is going to redeem the bonds if the price of the bond is redeemed at price if the price of the bond is greater than 130. So the company states this as a terms and condition that the company is having the power to redeem back the bonds if the price is in excess of 130. Same way, puttable mein, uh, the bondholder has a right. The bondholder has a right to return the bond at a price lesser than maybe 90. If the price of the bond falls below 90, the holder of the bond has a right that I don't want to sustain any more losses. I want to return the bond to the company. I'll give the bond to the company and the company will pay me 90 days. And this callable bond is like it is the right is with the company. That is, the company wants to avoid a higher bond pricing. It can redeem it at a prefixed price. If it is above certain limit, the bond is callable at a given price. And if the price goes below certain limit, then the bond can be put, or it can be sold, or it can be returned by the investor. These are the puttable and callable bonds. So euro convertible bonds, they can be also puttable or convertible. External commercial borrowings is what we say as commercial loans from non-residents with a minimum maturity of 3 years. External commercial borrowings is like you take loan from non-residents or foreign entities with a minimum maturity of 3 years. So who are going to provide you the external commercial borrowings? It can be International Financial Center, Asian Development Bank, or some export credit agencies, supplier of equipment. There are two routes for it to get the external commercial borrowings. One is an automatic route, and other is an approval route. There are two ways or two routes of getting the funding. One is the automatic route, and other is the approval route. So automatic route is like the investment or borrowing is allowed you to do freely. Approval means you need to take a approval from the government. Callable bonds from company's point of view, whereas puttable is from the holder's point of view. Yes, correct. So, but from where or who will decide the price of the bond or market price of the bond? Market price is never decided. It is always fixed by the forces of demand and supply. Okay, so that is always done by the way of demand and supply. With regards to the strike price, what should be the price above which or below which the bond will be called or put? That is again decided by the company itself, taking into consideration the rate of interest that is being offered and the market expectation as a whole. Okay. Some medium-term notes are also issued. So several lots of bonds can be issued with having different features with regards to, like, for a medium term, maybe 3 years, 5 years. You can decide the rate, currency. Entire documentation approval can be also taken at one point of time in case of medium term notes. Just as we have commercial papers in India, we have same way Euro commercial papers are short-term money market instruments having a maturity less than 1 year, usually denominated in USD. The Euro commercial papers are the short-term money market instruments which are having a maturity less than 1 year, which are denominated usually in USD. So if you want to borrow in USD, you can issue Euro commercial papers. Let's look at some of the specific and important fancy name of the bonds. For that, I have this table in front of you. There's a bond named as Yankee bond. Yankee bond, the currency of the Yankee bond is dollars. That Yankee bond is issued in USA. But who issues it, sir? It is issued by non-US banks and corporations. So, sir, Indian company, if it wants to issue bonds in US market in dollar denomination, can it do? Yes. That bond will be called as Yankee bond. So Indian company will be getting dollars, and that may be converted back to rupee for Indian operations. Similar bonds which are issued in Japan by a non-Japanese company are called as samurai bonds. Similar bonds which are issued in London or UK, London, UK, by a non-UK company, those are called as bulldog bonds. Just remember these names. I'm sure you will be comfortable with remembering those names, like Yankee for USA, samurai for Japan, and bulldog for UK. It's WRT. WRT is with respect to. Okay, let's look at some other typical bonds that are issued. FCCB, that is foreign currency convertible bond. Foreign currency convertible bond. So bond which is denominated in foreign currency and can be converted to equity shares. So they are very low rate of interest. They're issued at a very low rate of interest. Issuer can get foreign currency at a lower cost because they are convertible. So somewhere on the line, the rate of interest that is applicable over there, that is lower. Convertible floating rate note. So that is an option. There is a option on this floating rate note that though that particular long-term security can be converted to equity security, an option to convert it into a long-term debt security with a specified coupon, and it provides protection against falling interest rate. Capital gain is not applicable in such funds, right? JPY is, yes, Japanese yen. JPY is Japanese yen. If a foreign company issues bonds in India, what is it similar called as? India mein, if we have such bonds issued, those are somewhat, there's no specific name as such in India. So, but yes, we have something called as IDR, or Indian Depository Receipts. Indian bond market is not much developed as we look into the Western counterpart. So, convertible floating rate note is an option to convert it into a long-term debt security with a specified coupon. It means on convertible floating rate, initially it's a floating rate bond, but it can be converted to fixed rate. That's option, that option is there with you. Difference between Yankee bond. There's no difference. It's just the name that is given to us. Euro bonds are indirect sources of international funding. Yes, you can say that. Drop lock bonds. These are really interesting type of bonds that are issued. Drop lock bonds are like, these are the floating rate bonds that would be automatically converted to fixed rate bond. The drop lock bonds are basically floating rate bonds that are automatically converted to fixed rate bond if the interest rate falls below a predetermined level, and which is going to stay till maturity. The drop lock bond are a specific type of bond. Originally, these are floating rate bond, but they will be automatically converted to fixed rate if the interest rate falls below a given specified level. Like for example, if they say that the threshold is 5%, so the interest rates fall below 5%, they will automatically get converted to fixed rate bond. Variable rate demand obligation is another type of loan. So holder of a floating rate note, it's again a floating rate bond, which can sell the obligation back to the trustee as per at par plus accrued interest, thus making more liquid than normal floating rate. So variable rate demand obligation, the important term over here is demand obligation. So when we say demand obligation, whoever is holding that floating rate note, he is having that option to give it back. He's having that option to give it back to the issuer and get the face value plus the accrued interest. Yield curve note. Yield curve note is, it's again an inverse floater in which yield increases when the prevailing interest rate declines and vice versa. In floating rate note, we saw that as the market rate of interest increase, the rate of interest, the amount of interest that we are supposed to pay, that also increases. However, yield curve note is a reverse of it. It means if the market rate of interest is falling, I will be paying a higher rate. On the other hand, if market rate of interest is rising, I'll be paying a lower rate. So it's an inverse floater. Therefore, the term is inverse floater. Now, with respect to domestic context, we have masala bonds, municipal bonds, and government or treasury bonds. Masala bonds are basically bonds which are issued outside India but denominated in Indian rupee. So masala bonds are also basically a type of euro bonds because these are the bonds which are issued outside India. So outside India, someone is investing, and but the bond is denominated in rupee. Municipal bonds, the municipal authorities also are also raising funds through bonds for infrastructure projects. Recently, like Ahmedabad Municipal Corporation, even in Lucknow Municipal Corporation, they have issued bonds in the Indian stock exchanges. Then we have government or treasury bonds. These are the bonds which are issued by Government of India, Reserve Bank of India, or any other government department. So that entire part is our done. Now let's just look into first the lease financing part, and then we will discuss some other interesting points on it. Leasing is basically asset is purchased initially by a person called as a lessor, or it can be also a leasing company. Asset is initially purchased, and after that it is leased, or it is leased, or it is given to a lessee company. So asset is initially purchased by someone, and then it is leased, or you can say given on rent, right? So they pay a specified rent at periodical intervals. Lease financing, we have two types of lease financing, or two types of leasing. One is called as a finance lease, another is a operating lease. Finance lease and operating lease. Now, both of them are, you can say that finance lease may be for a longer term, operating lease is maybe for a shorter term. When we say finance lease, the risk and reward are passed on to the lessee, whereas in operating lease remains with the lessor. So if you get an asset on finance lease, all the maintenance, all the spare parts, any expenditure that you have to incur, the lessee has to undertake it. Whereas in case of operating lease, that remains with the lessor. It means it is the lessor who is responsible for managing, for maintaining that asset. So finance lease, virtual ownership gets transmitted to the person called as a lessee who has taken the asset on rent. Operating lease, the ownership is not passed. Legally, it's not, and not even virtually, or not even substantially. Risk of obsolescence. Sir, I bought a machine and I took it on lease. So what if that machine goes obsolete? The risk is on the lessee only, because if it goes obsolete, it's the lessee who has to pay for it. Whereas in operating lease, the lessor pays it. As I told you, the risk and reward, when it is remaining with the lessor, obviously the risk of obsolescence is also going to be with the lessor. Then lease cancelability. If you have taken a finance lease, you cannot cancel the lease. If you have taken operating lease, you can cancel it anytime. Cost of repairs and maintenance, as I told you, risk and reward are left with the lessee. So even over here, cost of repairs and maintenance is also going to be with the lessee only. In case of operating lease, the maintenance and everything is borne by the lessor. Full payout. Now, what is this full payout? In case of finance lease, lease is usually full payout. That is, a single lease repays the cost of the asset towards the interest. Means when you take a finance lease, generally that asset is leased for a longer period. Generally, that asset is leased for a longer period. So in finance lease, the lease is for a longer period. So it's generally that one party, it's the same one party who is going to pay the entire cost, entire expenditure of that finance lease, or of that asset is going to be paid by the lessee itself. Okay. And in case of operating lease, since it's a short-term lease, so for easy understanding, as I told you, finance lease is a long-term lease. That is lease for, like, if the life of the asset is for 5 years, the asset is leased for, let's say, 4.5 or full 5 years. So long-term leases, you can say it's a finance lease. Short-term leases are called as operating leases. So in case of long-term leases, virtually the maintenance, risk, reward, everything is passed on to the lessee itself. In case of operating lease, since it's a short term, you will lease your asset for maybe 1 year to one party, for another year to some other party, or third year you may lease it out to some other party. So there are going to be several users of the asset. Okay, so these are basic two types of leasing. One is a finance lease, another is a operating lease. Some other types of lease are sales and leaseback. Sales and leaseback means I purchase the asset, sell the asset to someone, and get it back on lease. Purchase the asset, sell the asset to someone by getting some cash, and then again get it leased back from us. Leverage lease, it means buying an asset on loan and then leasing it out or giving the asset on rent. Sales aided lease, this is like installment, or I can say this is similar to your hire purchase thing. Closed ended and open ended. Closed ended means once you have entered into a lease, you have to like continue it non-cancelable, and open ended is like you can cancel the lease. Okay, these are the various types of lease financing that we have. Understand, when you're reading finance lease, think it from the point of view of a long-term lease, operating lease from the point of view of a short-term lease, like maybe a year. And some other specific types of leases are sale and lease back, leverage lease, sales aided lease, closed ended, and open ended lease. Okay. Now we are left with few more concepts in this chapter. One is about the securitization, then international source of funds, which is GDR and ADR, venture capital, and export finance. So let's first talk about the international source of raising equity, which is called as the GDR or ADR. So what are these GDR or ADR? Let's understand it with the help of an example. See. Suppose we are over here in India. In India, we have the company of Infosys. Infosys, let's say, wants to raise money from USA. Infosys wants to raise money from USA markets, but Infosys cannot issue its shares. Finance leases are those which lessee rights are exercisable for a longer period. Yes, you can say so. Okay, so in USA, let's say Infosys wants to issue its shares in USA and get issued shares in USA and get money for the operations. So Infosys is not going to issue the shares directly in USA because it's not going to be allowed, because in USA also they have their own regulatory and legal authorities. So what Infosys will do is there will be a depository in USA. There will be a depository. Depository will be typically a banker in USA who's going to hold the shares of Infosys. So Infosys is going to give the shares to depository. So depository is going to hold those shares of Infosys, and against that, in US markets, depository is going to issue something called as ADR. ADR is American Depository Receipt. The depository is going to issue something into the US markets called as ADR. So depository will tell the US market participants that this ADR is issued. Depository is going to tell the US market participants that this ADR, or American Depository Receipt, is being issued. This is being issued for the shares of Infosys. For the shares of Infosys. So US market participants are going to pay against that ADR dollars to the depository. Then depository will remit dollars to Infosys in India. Depository is going to remit dollars to Infosys in India. And that's how Infosys is getting its shares listed on US markets. It's not listing its shares directly. It is going through depositories. It is going through depositories. So when I say it's going through depository, the instrument which is used in US markets is called as American depository receipts. Same way, if you want to go for some other market, maybe European markets, those will be called as global depository receipts. If some foreign country entity, like suppose if Apple wants to raise money from India, it will issue in India in lieu of its shares something called as Indian depository receipts, right? Company like Ola, Uber not purchasing any car. I'll answer that later. We're into the ADR now. So USA and India, we are saying with regards to USA and India, whenever an Indian company wants to raise money from US markets, it's going to issue ADR in US. If USA company wants to raise money from India, it's going to issue issue what we say as IDR or Indian depositories. Basically, when a company belonging to one country wants to raise owned funds from other country, we call that as a depository receipt. And since it's a global thing, we call it as a global depository receipt. So if it is issued in India, it's Indian depository receipt. US, it's American depository receipt, right? Or anywhere else, we call that simply as a global depository receipt. So international sources of owned funds, as we have said, these are GDR, global depository receipts. So these are negotiable certificates which are held in the bank of one country, representing a specific number of shares of a stock traded on a stock on the exchange of another country. It is a negotiable certificate. Certificate is issued by a depository who is going to hold the shares of the company held in the bank of one country, representing number of shares which are traded in a stock exchange of some other country. As I told you, there are two types, ADR and IDR. ADR is American Depository Receipt. They are issued by an approved New York bank. So as the name says, American Depository Receipts, they are definitely issued by New York bank or some other trust company against the deposit of original shares of a non-US company. Non-US company means, as I gave you the example of Infosys. The process of buying new issued ADR, whenever you are going to buy any newly issued ADR, that goes through US brokers, Helsinki exchanges, and DTC as well as Deutsche Bank. So these are all the regulatory authorities over there in US through which the process has to go through. As well as when you're issuing ADR, whenever you're issuing American Depository Receipts, you're also supposed to, whenever you're issuing those, you'll have to comply with their regulatory authorities. Their regulatory authority is Securities Exchange Commission. Securities Exchange Commission. So you'll have to fulfill their regulations. You'll have to prepare your books of accounts for US also as per US GAAP. US GAAP is US Generally Accepted Accounting Principles and Practices. So you have to follow your books of accounts. You have to prepare books of accounts on those lines. So some of the Indian companies that have listed, it's like those are Wipro, MTNL, State Bank. The first one to list was definitely Infosys, and also Reliance Industries is having its listed. Why for USA called ADR and why for other country called GDR? Because depository receipts initial concept originated from US, so the name stays over there as ADR, and wherever else we say it's a generic term GDR. Like you may have if the bonds are issued in Japan, it may be Japan depository receipt also, right? But overall, we say it's a global depository receipt. Whenever any company wants to raise funds, equity funds from other country, we call those as GDR only. Those GDR may be ADR or IDR or Japanese depository receipt, Australian depository receipt, anything. Right. So IDR is like foreign companies coming to India to raise funds from the Indian capital markets in the same lines as Indian company using ADR to raise foreign capital. Okay. Is the money raised through ADR or GDR to be utilized for operations in that country or the home country? That is allowed for both the cases. Since the shares are traded via depository, thereby getting listed on foreign exchange isn't necessary. Yeah, shares are not supposed to be listed. You're not supposed to list your shares on the New York Stock Exchange because your ADR is already listed over there. So ADR, GDR वहाँ पे listed है. So you need not issue it. You need not list it again. Infosys need not list its shares on the New York Stock Exchange because they are already listed through depository receipts. Understand another concept called as securitization. Really interesting thing, securitization. Can I give some example of ideas? As of now, we don't have any such issue in the Indian markets because Indian markets are not that. Indian market is more of like an investment thing. It's not from where you need to raise the funds. Yes, that's the concept which is still prevailing. Securitization. When we look at the term securitization, what do we really mean by it? Let's understand it. Let's understand it with the help of this diagram. Generally, this is what we observe. This portion is what we observe in the market. There's a financial institution or a lender. Let us say this particular financial institution is let's say State Bank of India. Okay, let's say that it's a State Bank of India. The State Bank of India has actually given loan to numerous borrowers. There are a number of borrowers to which State Bank of India has already given loan. So State Bank has given loan, and against those loan, uh, State Bank is receiving monthly EMIs from the borrowers. So borrowers are paying monthly EMIs to State Bank of India. So now, if you look into the balance sheet of State Bank of India, you will find that it has some amount of loans given to the borrowers. Now, what State Bank of India is going to do, State Bank of India is going to do is it wants to monetize these assets because once it has granted the loan, the loans are granted for a long term. Loans are granted for a long term. If for issuing shares in foreign country, company can by self comply with what country's regulation? Then why need for depositories? For issuing shares in foreign country, company can comply. Foreign country regulation will be required, not the home country. If Indian company uh, wants to raise money from US, it has to also comply with US regulations. And also it will have to prepare the books of accounts also in US terms. I mean, in Indian rupee as well as in US terms. Coming back to securitization. So under securitization, we say we have a State Bank of India. Loan proceeds are given to the borrowers. Loan proceeds are given to the borrower. And the borrower makes EMI payments. Borrower makes the EMI payments. So in this entire securitization process, the money is flowing from the borrowers. EMIs are paid by the borrowers. EMIs are paid by the borrowers. The financial institution or State Bank of India is now thinking to monetize this because a huge amount of money is blocked. A huge amount of money is blocked in with the borrowers, and it wants to monetize it, or it wants to have some liquidity. Wants to have some liquidity in its books. So what it does is it creates another entity called as a SPV, or it also called as an issuer. SPV is special purpose vehicle. So a special purpose vehicle or a separate company is created. And what State Bank of India says to the SPV is, hey SPV, just look into it that I'm going to sell you all my loans. I'm going to sell you all my loans. That is, whatever loans I have, you take the right of it. I mean, whatever right I have to collect the money from the person, collect the money from the borrowers, you take the right, you take the money from them. or I will pass on the money to you. I'll pass on the EMIs to you. But for all those loans, you make me a upfront payment. You make me a upfront payment. So the issuer is going to say, okay, I'll make you upfront payment, but how am I going to give you the money? Because I will need money to pay you the value for these loan amounts. So the state bank says, do one thing. You issue securities to the investor and tell the investor, you issue securities to the investor and tell the investor that, hey, investors, you're going to get coupons, you're going to get the principal amount or the loan repayments from these borrowers. It means the borrowers will pay the money to State Bank. State Bank will pass on the monthly payments to the SPV. The SPV will pass on the monthly payments to the investors. Basically, instead of money being kept by State Bank, what State Bank is saying is, I will pass on whatever EMIs I get after deducting some nominal charges, and you give it to your investor and ask the investors to buy your securities. Ask the investors to buy your securities, and those securities which are issued are called as mortgage-backed securities. Those securities are called as mortgage-backed securities. Means mortgage-backed securities simply means that these securities are backed by some mortgages. Because ultimately the investors who are going to get the money, that is going to flow from the borrowers. Okay? The investors are going to pay cash to the SPV. SPV will make the payment of cash to State Bank, and now State Bank is like, okay, I have received my money. I just have to pass on the money to the investors. And this issuer or SPV comprise of, there's a trustee, there's an underwriter, there is a rating agency, and also credit enhancement provider. Now, I cannot discuss about credit enhancement provider. It's an entity which helps you to increase the credibility of your securities. So it has got like the 4 steps. Borrower obtains the loan from financial institutions with the help of mortgage broker. After the loan issued, the borrower and the lender will not have much interaction with the mortgage broker. Lender or the financial institution sells the loan assets to the SPV and provide the service between borrower and issuer SPV. Issuer or SPV sells the securities as bonds to the investor. Rating agency rates the securities, credit enhancement undertake, and then this servicer is going to collect money from the borrowers and pass it on to the investors. That's the process of securitization, wherein a banker is going to liquidate its loans. The banker is going to liquidate the amount of the quantum of loans that it has. I will suggest you to look into a video. Are these mortgages issued at discount to SPV? Need not be discount, because it depends whether it will be at a discount or at par. It depends on the profile of the borrowers. If the borrowers are if the borrowers are of good credit worthy, then the discount will be very minimal. Whereas if the borrowers are not credit worthy, then obviously the discount will be a higher amount. I'll suggest you guys to go to YouTube, and over there search for something called as subprime crisis. Subprime crisis, and you'll find an animated video. I think in the first few only. Just remember, it will be a green background animated video, wherein they have very beautifully explained the securitization aspect and why this securitization actually led to the crisis of 2008 in US, and also that was felt all over the globe. Securitization was one of the securitization was one of the primary reason for the subprime crisis of 2008. So YouTube, just go to YouTube and search for subprime crisis. Later on, after the lecture, you can look for subprime crisis, an animated green color, green background animated video. You will find it's 17 or 18 minutes. I don't think, I think 11 or 12 minutes video, which will give you a complete picture of how securitization happens and how, due to greed, the entire US markets came to a standstill or it just fell down. Let's look into another aspect called as venture capital financing. So venture capital financing, basically they are equity finance. They are again source of equity finance given to the startup companies, wherein long-term investment, which are you make an investment for a long-term growth oriented. In simple way, borrowers indirectly borrow from public in general. Yes, you can say indirectly borrowers are borrowing from public in general. So venture capitalists are basically providing support in the form of sales strategy, network, and management expertise. I don't know how many of you really watch some of the good series like Dragon's Den or Shark Tank. Uh, any one of you have seen those series, Shark Tank or Dragon's Den? Dragon's Den is based on UK market, and Shark Tank is on the US markets. So they are the venture capitalists. So the persons who sit over there, they are venture capitalists who provide funding, for startups. So startups come up with the idea, and you are supposed to give them funding. They will explain you their product, and if you like the product, if you like the business, you will be investing in them. Right? So these startups are also going to provide support in the form of sales strategy and also management expertise. If you look into those series, you will also know that they offer business opportunities. They also offers networking and management expertise. Some common methods by which the venture capital is undertaken is, sometimes the startup may not be able to provide returns. So what venture capitalists do is they take equity participation, and they will definitely not exceed 49%, because if it exceeds 49%, then the control goes to the venture capitalist. They'll also give you something like conditional loan, which is repayable in the form of royalty. Is repayable in the form of royalty. So, like instead of paying interest, they ask you like whatever product you sell on those product you pay like 10% of the sale value as a royalty, right? So startup may not be able to provide returns during the initial stages. So ownership is given, conditional loan may be given. The royalty ranges may be like 2% to 15%. A choice may be given to the firm to pay higher rate of interest instead of royalty once it becomes commercially sound. Income note can also be issued, which can be a hybrid note, hybrid security, which combines features of both conventional loan and conditional loan. Conventional loan, wherein a fixed rate of interest is paid. Conditional loan is like, depending on your profitability, my rate of interest will differ. Then participating debentures can also be issued. Participating debentures can also be issued, which carries a charge in 3 phases. Participating debentures are issued in 3 phases. In the initial phase, no interest is charged. The initial phase, participating debentures, no interest is charged because you are still in the initial phase, and we cannot ask you any interest because you don't have any much money to pay interest. In the next stage, some lower rate of interest is charged up to a particular level of operation, and once you reach a maturity, once you are having a greater scale, higher rate of interest will be required to be paid. The venture capitalists are definitely going to provide investment into the new companies which are risky and also having a potential of high growth. Okay. We're left with the export finance. So before that, let's just quickly look into, in Shark Tank. You have seen ownership surpassing 49%. Yes, they can, like if they're really in need of money, the ownership can also exceed 49%. venture capital, where the spelling of series of venture capital financiers. Let's have a MCQ session, guys, before we end our today's session. Shall we have a MCQ session? Yep. Let's have a MCQ session wherein I'll share you with the PPT. Okay, look into the first question, guys. For callable and putable bonds, which of the following is least accurate? What would be the correct answer? Callable and putable bonds, which of the following is least accurate? Under callable bond, obligation is on the investor, and under putable, obligation is on the issuer? Or is it under callable bond, right is with the issuer, under putable, right is with the investor? Under both callable and putable, right is with the issuer only? Yes, I'll share this MCQ file also. Don't worry. What's the answer? A, B, C, D. Yes, students. What could be the answer for this? A, B, C. Correct answer is option C, guys. Under both callable and putable, it says right is with the issuer. No, it's not the case. Under callable, right is with the issuer. Under putable, right is with the investor. Callable, in case of callable bond, the bond can be called or the bond can be redeemed before due date by the issuer, and under putable, it is a right with the investor. You find option A is correct because obligation is on the investor. Under putable, obligation is on the issuer. Obligation under callable bond, obligation on the investor that he is supposed to, he is or like investor is bound to give back the bonds. Okay. Look for the second one. Second one, Second one, in case of drop lock bonds, dash rate bond will be converted to dash rate bond if interest rate dash a predetermined level. Second question, what's your answer? In case of drop lock bonds, dash rate bonds will be converted to dash rate if interest rate dash a particular limit. Drop lock bond. Drop lock bond was something which was converted from floating rate to fixed rate if interest rate falls. So option A is correct one. In this case, option A is correct one. My bad. Option B is correct one. Floating rate to fixed rate. I said floating rate to fixed, but I said option A is correct. So it's floating rate to fixed rate if interest rate falls below a predetermined level. Let's go for the third. Bulldog bonds are issued in dash by dash. Are Bulldog bonds issued in UK by UK company, or are they issued in UK by non-UK company? Are they issued in India by a UK company, or are they issued in Germany by a UK company? Bulldog bonds are issued in definitely in UK by a non-UK company. Third one. Which of the following is the least accurate to be called as a method of venture capital financing? Least accurate to be called as a method of venture capital financing. We have just seen it. Do we provide equity financing for initial stage startups? Yes, that is a type of equity financing. Is it a conditional loan repayable in the form of royalty? Is it a conditional loan repayable at a low rate of interest till maturity? Or can it be a participating debentures? So, correct answer for this is least accurate to be called as a method of venture capital financing. Least accurate. Remember, it's a least accurate. It means out of these four, which is not a correct one. Of course, it's option C, guys, because it's a conditional loan repayable on low rate of interest till maturity. No. In case of conditional loan, the rate of interest is higher as the business expands till maturity. Next one. Which of the following is true with regards to securitization? We just saw the securitization. It is a method to convert liquid pool of assets to illiquid securities. We convert liquid pool of assets to illiquid. No. It is not feasible if there is no active secondary market for debt markets. The investor of marketable securities is called SPV. The original borrower is aware of the investors of securities to whom his EMIs are paid. So we want to know which is the true statement over here. True statement is option B, as it is not feasible if there is no active secondary market for the debt securities. This is not feasible if there is no active secondary market, because those securities which are issued, those should be traded in the market. If there is no secondary market, no one is going to buy those securitized securities, and therefore it's not feasible. Which of the following is the least accurate with regards to commercial papers? So, a commercial paper is an unsecured money market instrument issued in the form of a promissory note. It is a type of short-term borrowings. All corporate borrowers are allowed to issue commercial papers. Credit rating is mandatory for commercial papers. Well, in this case, The correct thing is all, I can say the option to be chosen over here, the least accurate option is all corporate borrowers are allowed to issue commercial papers. No, it's not that the case, because only the highly rated borrowers are allowed to issue commercial papers. Cash credit facility is generally sanctioned against what? Remember, cash credit facility. Cash credit facility is generally sanctioned against tangible assets, intangible, tradable, or land. Cash credit is generally sanctioned against tradable goods. Tradable goods. Which of the following is least accurate with regards to certificate of deposit, CDs? Least accurate. It means which of the following is going to be incorrect? Issued by bank. Investor faces illiquidity as banks do not encash CDs before maturity. CDs are traded in secondary market, or it is a document of title. Which of the following is a least accurate? So least accurate is option B, that investor faces illiquidity. Investor doesn't face illiquidity because those are traded in secondary market. Those are traded in secondary market. So investors can definitely get the liquidity. They can sell it in the secondary market and get their money back. Next question. Which of the following best describes a euro bond? Is it a bond traded in Europe? Is it a bond of a European company? Is it a bond which is denominated in a currency other than that of a country in which they are issued? It is generally issued as a registered bond. Which of the following best describes the Eurobond? Eurobond, we have seen, no, it has nothing to do with Europe. The option D is also not correct because they are generally issued as bearer bonds. So best description goes with option C. So it's the option C which is correct for this question. Which of the following is not a feature? It's not a feature of ADR. First off, is it a security of a non-US company listed on US stock exchange? Yes. Provision of SEC, Securities Exchange Commission, need to be followed. For trading existing ADRs, foreign brokers or custodians are involved. Companies who have ADRs issued in US GAAP or US markets have to provide full half-yearly and quarterly accounts as per US GAAP. So not a feature. We say option C is not a feature. Because already the ADRs who are already being issued, they are in existence. No permission from foreign brokers or custodians are required. They are freely traded on the stock exchange. With that, we are done with the MCQ part also, guys. Got good set of response from the students for the MCQs also. Okay, many of you have made it correct. We have completed the sources of finance except the part of export finance, which is a very simple part. We have two portions of it: pre-shipment and post-shipment. So before shipping finance is called as a pre-shipment, and post-shipment is called as a, if after shipment is called as a post-shipment finance. We'll look into that. We're already crossed our time limit, so we'll look into that part in our session tomorrow. Complete this export finance and then go to the next thing or next chapter, which is the ratio analysis. So for the time being, let's just stop here for the day, guys. Will the notes be uploaded? Yes, definitely. I'll be uploading the notes immediately, or else I'll just do one thing. I'll upload it right now itself. Paper-8A. this session. Yeah, I've uploaded it, guys, so you can find it in your notes. So let's just stop here for the day, guys. We'll meet again on Saturday. So let's just stop here for the day. Good night, take care, and enjoy.